Welcome back to part 2 of our special series on the microcap brief. In our last episode, we detailed the stunning turnaround of Phoenix Interactive. We outlined their three-phase playbook, which took them from a failed lottery business on the brink of collapse to a rebranded media conglomerate. Phase 1 was about survival. The new management team systematically dismissed major lawsuits and regained full NASDAQ compliance. Phase 2 was the rebirth. They rebranded the company and, most importantly, secured a massive $450 million financing commitment to fund a new vision. Phase 3 was aggressive execution. They rapidly acquired a portfolio of assets, including a major ticketing platform, invested in a high-growth esports media brand, and began global expansion. Today, we move from that story to the analysis. We're going to look past the press releases and dissect the immense risks, the market's reaction, and the critical numbers you must watch. The first and biggest risk in a story like this is execution risk. In the summer of 2025 alone, Phoenix Interactive announced at least 7 major strategic moves, from multi-million-dollar acquisitions of ticketing and digital sports platforms to securing hundreds of millions of financing and launching new global divisions. This creates immense integration risk, the challenge of merging completely different business models, technologies, and company cultures all at once. Can a small, newly stabilized company truly digest a ticketing business, an esports media empire, and a global sports incubator simultaneously? The ambition is impressive, but the potential for operational fumbles is enormous. Second, we must perform a financial reality check. That $450 million financing commitment is the fuel for the entire turnaround. But it's not free money. It's an equity line of credit, which we've covered in depth. This means the company can sell new shares to its financing partners to raise cash, which leads to dilution. Every time they draw down on that credit line to fund an acquisition or cover operational costs, the number of shares outstanding increases, and each existing share represents a smaller piece of the company. Investors must watch the quarterly 10Q filings like a hawk to see how many new shares are being issued and how quickly the company is burning through its cash to fund these new operations. Third, we must decode the market's reaction. Despite the flurry of positive news, the stock has remained incredibly volatile. Let's look at the reverse stock split. The company's press release on August 27th framed it as a strategic move for growth, but the market's reaction told a different story. The day it was announced, the stock closed at $6.32. Just 2 days later, on August 29th, after the split took effect, it hit a low of $3.96, a drop of over 37%. This is a classic lesson. The market often views any reverse split as a sign of weakness, regardless of the narrative. The other key data point is institutional ownership. Publicly available data from this period shows it remains very low, under 2%. This tells us that the so-called smart money is still on the sidelines. They've seen the playbook, now they are waiting for proof of real, sustainable revenue before they invest. This brings us to your key takeaway. A credible turnaround requires more than just a good story. It requires a clear break from a failed past, a bold new vision, and a management team that can execute. But as an investor, your job is to look past the story and analyze the numbers. This leads to your homework, which is the ultimate checklist for analyzing any potential turnaround you find. Track the cash. For any company you analyze, open its latest quarterly 10Q. Find the cash flow statement. Ask yourself, what is their quarterly net cash burn? And, based on the cash on their balance sheet, how many months of survival or runway do they have left? Verify the new revenue. In that same 10Q, look at the income statement. Is the new revenue from the company's new strategy actually showing up? For instance, in the Phoenix Interactive case, you would be looking for proof of that projected $5.2 million from their new international operations. Is the revenue growing quarter over quarter? Remember, press releases announce deals, 10Qs report the actual results. Follow the smart money. Use a financial data website to look up the institutional ownership of the company you are researching. Is that percentage increasing over the last few quarters? This is one of the best indicators of whether professional investors are starting to believe in the story. If a company is telling a new story, but the financial proof isn't there yet, you have found a potential turnaround. Your job is to decide if you believe in their ability to execute.
Thank you for listening to the Microcap Brief. Do your own research and invest wisely.